Let's get more on these U.S. oil inventories, and let's bring in Andrew Lebow, Senior Partner at Commodity Research Group. It's always great to have you. Thanks very much indeed for joining us, Andrew. I don't know where to begin. That was a huge drop in U.S. oil inventories.
Yes, it was. But let's not forget that last week inventories built by over 9 million. So the net is probably unchanged between the 2 weeks. But relative to expectations, it was a big drop. The consensus, I think, was a build of over 2 million. If you look at the numbers, there was something for the bulls, something for the bears. U.S. production was up again, up another 100,000 barrels a day, up to 11.9 million. So we've risen by 200,000 barrels a day in just the last 3 or 4 weeks. So production is definitely on the rise, and so are exports. The reason we drew so much is that crude exports were way higher than expectations. So you have high exports like that, you're going to see a draw, and I think that's going to continue. A lot of the SPR barrels that are going to be released, a lot of that's going to be exported.
Yeah, you guys have just posted record figures for crude exports. Apparently, they just jumped above 4 million barrels a day. Whoa, that's a lot of oil coming from America.
Yes. I mean, we're one of the marginal suppliers now. There's good demand from Europe, of course, for our barrel. You know the discount that WTI has had to Brent, so we're relatively cheap. And more U.S. crude is coming out owing to the release of the Strategic Petroleum Reserve, which is continuing to come out. This week there was 700,000 barrels a day, I think, what was the number that was released, and we're going to go up to over 1 million barrels a day of U.S. crude releases coming up in probably in May.
Right. Now, so that 4 million barrels a day, I'm not clear if that includes refined products as well. But anyway, you guys are exporting an awful lot of oil.
It does not include refined products. That's just the crude number.
Wow.
And it's, as you mentioned, that's an enormous number.
Yeah.
And because of that, that's why we drew so much.
Now, diesel, it looks like this tight diesel situation is not getting better because you've got this ban on Russian oil imports, and I think the actual cutoff date is nearing fast. And that has now, according to Bloomberg, cut supplies of diesel to the lowest since on the East Coast, where most of the population is, to the lowest since 1996. So diesel's super tight.
Diesel is, we can almost say it's in shortage. And that was a point I was going to make, Andrew, that in Pad 1, which is the Northeast U.S. and where the delivery point is for the diesel contract is as tight as it's ever been for this time of year. Well, going back to 1996, so I shouldn't say ever. And again, this week we had a draw of almost 2.7 million barrels, and most of that was in Pad 1. And what we're seeing here, and again, the Pad 1 is the Northeast, and what we're seeing here is a backwardated or an inverted market where the cash market or the April contract is trading over 30 cents a gallon above the May contract. And when you get that type of an inverted market, that's indicative of a really tight market. Diesel, I mean, it's short. It's really short.
That's interesting. Yeah. So, you got backwardation in the diesel market, in other words.
Strong, heavy backwardation. 35 cents a gallon. I mean, and it had been very strong in Europe last month, over $100 a ton. That's given some up. But diesel globally is really tight. The Russians were a big supplier of diesel. They supplied almost 1 million barrels a day to world markets. So that is, that has been owing to self-sanctions. People are just not lifting diesel.
Where is WTI going? I know I always ask you this impossible question.
You really do.
But is it headed for $110 again, do you think, Andrew?
I'm a little bearish, actually. Certainly, could it get to 110? Yeah, if the EU decides that they are going to embargo Russian crude right away, it could go way beyond 110. But looking at the balances, to me, Russian crude losses are going to be made up by the U.S., by the SPR, by other non-OPEC producers, and by demand loss. If you demand less petroleum, that counts. On the balances. So for second quarter, I see a slight build, which I think could pressure the market, not too much. We're in a 92, 115 type big trading range here. Is it possible to see both numbers in the next few weeks? Yeah, sure. It's sure possible to see that.
Yeah, it's interesting. And Andrew, we got to let you go now. But as you say, U.S. crude production now hitting 11.9 million barrels, the highest in 2 years. Yeah.
Right. On the rise.
Andrew, thank you very much indeed.